Hello, good evening, and welcome to Economic Forum. In this series, we will be discussing non-interest finance in Ghana. This is one of the many series that we're going to do under Islamic Finance Education Series, simply shaped to bring understanding awareness to what Islamic finance is and why it matters to Ghana. I'm going to be your presenter of this series throughout, God willing, inshallah. And my name is Professor Abbas Mohammed Al Amis Ali. I'm qualified with a doctorate in economics, Islamic finance, and banking, among other qualifications. I want to welcome you to an insightful, uh, you know, series of this particular important topic. Once again, I greet you with the greetings of Islam. Assalamu alaikum wa rahmatullahi wa barakatuh. And you are all welcome. I begin by bringing your attention to what many of you have heard, Islamic finance, non-interest banking in the news recently. It's going viral. Recently, Bank of Ghana appointed a sheikh from Nigeria to lead the council. And it has brought a lot of attention to the matter. And I just want to throw some light as an expert in that field. So we're not here to debate religion. I have to make it clear. I'm not here to debate any religion. But I'm here to bring understanding to a financial system, its principles, how it works, and what it could mean for Ghana's economy specifically. Here, I want us to understand that this series is aimed at bankers, regulators, entrepreneurs, and general public, and not just Muslims. So the full series will cover, in part one today, we will try to cover foundational principles. The later parts will cover specific instruments and products, such as Murabaha, Hijara, Musharaka, Mudaraba, home financing, SME financing, Sukuk, which means Islamic bonds for infrastructure, what have you. At this point, I don't want you to be backed down with the meaning of some of the terminologies that you're going to hear me mention, because in due course, as you listen and listen further, I'm going to break it all down. So let's start with the question everyone asks. Why is Islamic finance and what does it matter? The question is, a growing number of banks, investors, and regulators are talking about Islamic finance, sometimes called non-interest banking. And I know it's very interesting how Bank of Ghana chose the word non-interest banking to pass their guidelines as of January 2026, because they don't want to appear favoring one religion against the other religions, which to me is fair. So what we're gonna find out is that Ghana regulators have already begun exploring a non-interest banking framework. And this isn't hypothetical. This is an active policy conversation that's going on in Ghana, behind the scenes if you don't know. But a common misconception here is many people assume Islamic finance means finance for Muslims only, or religious, charity or some sort. I want to clarify that it is not financing for Muslims only. It is a commercial system with its own logic. And in countries like UK, Malaysia, and increasingly in the US, where I am, a large share of Islamic finance customers are actually non-Muslims, drawn to it for ethical transparency reasons. So this is going to be part one of the ongoing series. All right. This part one is going to walk us through the ideas, the instruments, a real Ghanaian application of no-interest financing, starting here with the foundation. All right, this is of the mini series. So, despite the name Islamic finance is not exclusively for Muslims, and it is not simply banking without interest. It is a distinct philosophy about how many or how money relate to the economy. Let it be clear, it's about how money relate it to the economy. So it's not just no interest. If it's not just no interest, let's define it properly. So we would define it this way. I want you to bring your attention to the fact that Islamic finance is a system of finance that operates according to the Sharia or Islamic commercial law. The Sharia, as a broad concept or jurisprudence, is very extensive. And Islam has been able to carve a niche on commerce. And history tells us how successful though Islamic dynasties has done, such as Umar bin Aziz, who did a good job of running an economy fully on Islamic principles. And if you care to read the history, you'll find out the examples of several leaders after the Prophet who actually try to exemplify what we're trying to do here in some of the activities that has to do with commerce. So I want us to bring our attention to some basic principles that stands in a way of understanding Islamic finance. Number one is that the money connected under this principle, any money connected to any transaction must be tied to a real economic activity. And that the risk and reward must be shared fairly between two parties. And that transaction conducted under this principle must be transparent and be mutually agreed upon. So let me take you through one by one. Under this principle, money connected to any transaction must be connected to real economic activity. In other words, there is no riba, and asset has to back that transaction. Riba means interest. So when you use the word riba in this discussion, it's going to mean interest. So there's no interest, which is going to be a principle 1 and 3 that you're going to see. I've labeled all the principles eventually as I go forward. So when I talk about money connected to real activity, I'm speaking to principles 1 and 3 under my arrangement. And the risk and reward shared fairly will set up the principles that we're going to talk about in principle number 2, which is al-gumd bil-gurm. Al-gumd bil-gurm refers to risk and reward, that every reward must be associated with risk. Number 3 is going to be transparency and mutual consent, which would then cover principle number 4, as you're going to see, which emphasize the fact that there is no gharar and no maisir. Gharar meaning uncertainty, maisir meaning gambling. So we're not going to tolerate that under Islamic, finance. So I want you to think about this example. When you put it all together under the definition of Islamic finance, we want you to think of a situation or the difference between equity investing versus a payday lending. An equity investor share in the ups and downs of a business, correct? And a payday lender collects a fixed fee no matter what happens to the borrower. Islamic finance philosophically sits close to the equity end of the spectrum. So let's make that concrete. There are about 7 principles I'm going to share here for every Islamic product to trace back to. Here we go. Every product will be built on these 7 core principles. Number 1 is the lack of interest, no riba on the money lent. So under this principle, earning a predetermined return simply for lending money is prohibited. Profit must come from real economic activity and not the passage of time on a loan. That's principle number one. So the prohibition isn't only on making the money, it is specifically on earning a guaranteed predetermined return simply for the passage of time on loan, regardless of whether the borrower's venture succeeds or not. Contrast that to a conventional bank that earns 8% whether the borrower's business booms or goes bankrupt as long as they don't default. That fixed risk-free return on a loan is what's prohibited. Principle number two, the risk and reward are shared. This is al-gumd bil-ghurm. The risk and reward are shared, which is arguably the most important principle in the whole framework, and one that I want people to understand because that is the most least understood principle. Literally, what it means is that every gain accompanies liability. That if you want the upside, you must accept the downside. This is why we use partnership, such as musharaka, mudaraba, covered in past 6 and 7 of this series exists. So we let the financier share in the business actual performance rather than collecting a fixed fee regardless of the outcome. Principle number three talks about asal al-mal, which is finance tied to real asset. Okay, there has to be a real asset tied to the transaction, where money is not a commodity to rent out for fee. Every transaction should be linked to a tangible asset, trade, service, or productive enterprise. So what do? We treat money as a medium of exchange only, not a commodity that generates more money on its own, which is under the conventional sense. They lend you money, the money earns interest. This is the philosophical root of Murabaha, part 2, that we're going to talk about, and Ijara, part 5. All right, sales and leases are inherently tied to real identifiable assets. So a good example I want you to think about is money is like a ruler. You use it to measure value. You don't rent out the ruler itself for a fee. The next set of principles I want to bring your attention is number 4, no excessive uncertainty, no garar. Not all uncertainty is prohibited under this scenario, and that contract should be clear about what is it being bought, sold, leased, invested in. Ambiguous or deceptive terms that create unfair uncertainty are avoided. But we have to be very clear about something. Like I said, not all uncertainty is prohibited. Normal business risk is fine and even necessary in some cases, as in principle 2. What's prohibited is ambiguity in the contract itself, not knowing what you're actually buying, at what price, on what delivery date, under what terms is something that we prohibit. Example is, under the conventional sense, selling a catch of fish before the net is even cast, with no idea of quantity and quality, is garar. Is garar. So practical implication for banking is that contracts under this guidance must clearly disclose price, asset, timeline, and obligation upfront, which is actually a strong consumer protection principle if you think about it. It's not just a religious rule, it actually gives you a protection. So I want Ghanaians to think about that. So we don't do predatory lending under Islamic principle. So, principle number five is no gambling or pure speculation, which is MISO. That transactions structured as a zero sum bet, where one party's gain depends purely on the chance rather than productive effort. This falls under what is permitted. So, under no MISO or no gambling or pure speculation, one party's gain is purely another's loss is avoided with no productive value created. We avoid that. This is why selling purely speculative derivatives and short-term speculative instruments sits outside the Islamic finance comfort zone. Even though ordinary commercial risk taking, like buying inventory, might not sell, or buying or investing in a business that might not succeed, is fully acceptable. All right. So, principle number six is ethical screening of what's finance. So, halal investment. What is that? It's Islamic finance that does not fund industries considered harmful, such as alcohol, gambling, weapons, what have you. The ethical filter is part of underwriting, not an afterthought under Islamic finance. And this is actually a social responsibility investing that a lot of other, you know, audience are gearing towards. That's a mainstream now in the conventional financing. So it's not a logic that's foreign, as people assume. All right. So to sum it up, what we've talked about is to look at no interest, shared risk, real assets, no ambiguity, no gambling, ethical screening. And then add on top of that the seventh principle, which is closely tied to sharing, risk sharing, is especially important for anything involving leasing or ownership. So let's bring that. That's the final principle. That's al-kharaj bil-demand. That means return follows responsibility, or responsibility comes with ownership. So you're not only entitled to income or benefit generated by something you own if you also bear the liability for its loss, defects, or upkeep. So in leasing under this principle, Hijara, for example, the owner, not the tenant, must bear the major asset risk in exchange for the collected rent. And that shifting that risk entirely to the customer while still collecting the rent as an owner breaks that principle. So when we bring all these seven principles together, actually these two principles, if I should mention here, al-kharaj bil demand, al-gum bil grum, is the principles of risk associated with reward and then ownership with responsibility principles are what we usually use in stress tests for home financing or to really determine whether a contract is actually Islamic. And that was actually my thesis for my doctorate degree, where I analyzed the American home finance. And I have the article to support that, where I propose a certain metric that must be used to analyze whether it's actually Islamic. So the seven ideas that we've shared here, one philosophy is no interest, shared risk, ownership responsibility, real assets, no ambiguity, no gambling, ethical screening is what Islamic principle is all about. So with all the seven principles now on the table, let's test them against a real world example of what can go wrong when they are ignored. So what does this actually change? I want you to walk away knowing that when we talk about Islamic finance, it's all about substance. If you look at the seven principles I've given you, it builds the substance on which the instrument is designed, not just renaming a contract. So it's not taking a conventional loan and simply renaming the interest rate as a fee. Mm-mm. Instead, it's a structure that shapes the transaction around a sale, lease, or a genuine partnership. So the bank's return comes from real economic participation, not from lending cash at a markup. Later, we will explore how this actually plays out under instruments like Murabaha, Ijara, Musharika, Mudaraba, and all of that. So that's what I want you guys to think about. So why should any of this matter to someone sitting in Accra, Kumasi, or Tamale? Let's talk about the numbers. The global opportunity I want to bring your attention to. Why this mattered in the Ghanaian perspective. A global pool of capital, not just a local product, is what we're talking about here. Islamic finance is one of the fastest growing segments of global financial market, and Ghana is positioned to tap into that, not just adapt to it. As we speak today, the last time I checked, global Islamic finance assets stands at $5.98 trillion, up year on year about 21% growth. Projected global asset is about $9.7 trillion, with outstanding Islamic bond called Sukuk standing at $1 trillion plus. And this industry spans across 80 plus countries and over 1,500 institutions, concentrated in the Gulf and in Southeast Asia, but actively looking for new markets, including West Africa. So if we do this well in Ghana, it wouldn't just serve Ghanaians locally. It will position Ghana to attract a share of the global capital pool. Roughly about half of this capital sits in the Gulf region. Saudi Arabia, UAE, Qatar, to name a few, and about 20% in Southeast Asia, Malaysia, Indonesia. West Africa is largely untapped, which is the opportunity, not a weakness. Ghana will not be entering a crowded, mature market to be an early mover in its region, with the Skook sitting at $1 trillion. All right. Ghana adopting a foreign banking style out of politeness, that's not the case here. It's about Ghana positioning itself to attract a share of nearly $6 trillion in the capital that is actively looking for new credible market. So we're going to go beyond the global story and then even look within Ghana. Imagine a situation where our projects, infrastructures are financed under this financing model, where we're not paying interest rate as high as 20% to finance our loans. What relief would that be to the Ghanaian population? That's what you have to think about. So beyond the global capital story and the benefit that we stand to gain, let's talk about Ghana itself and the Ghanaians, why it matters to us. We have to be honest. We have a Muslim population that's underserved in Ghana. Ghana has a significant Muslim population, roughly, depending on which census data you're looking at, about 18 to 20% is up for debate, but is currently exclusively underserved by the conventional banking system, interest-based banking. So that is this one straight away is financial inclusion argument, which gives a portion of a population banking option that matches their preferences. Number two, It opens Ghana to the global capital market. The FDI, foreign direct investment, diaspora investment angle. All right, this will create the Gulf Sovereign Wealth Funds, the Sukuk Islamic Investment Funds, actively looking for Sharia compliant opportunity in emerging market. All right, allowing us to invest and source funding for our project at a lower cost than the conventional market. And three, let's talk about financing structures for our small, medium enterprises. This is a big one for Ghanaian business audience specifically. I want them to pay attention. So we're going to talk in part 9 of the series, SME financing. But I want to bring your attention to some of the instruments that you're going to hear in the future series, Musharaka, Mudaraba. You know, these are all opportunities where a financial institution invests alongside an entrepreneur rather than lending against collateral that the entrepreneur does not have. And the fourth one you could think about is asset-based financing for agriculture. So the Salam contract, which we're going to cover in part 9 also, highly relevant to Ghana's agriculture, especially you talk about cocoa, maize, rice farmers who need capital before harvest. We give them the opportunity under this. All right. Then we can talk about alternative paths to home financing. In part 8, we're going to talk about diminishing musharaka, Islamic home financing relevant to Ghana's housing affordability challenges and limited mortgage penetration. All right. So above all, what is this to Ghanaians? Ethical finance beyond Muslim customers. It's going to go beyond Muslim customers. I made reference to markets like UK is booming and discussions still going on to make it better. Malaysia, they're already way ahead in terms of some of these things. And a meaningful share of Islamic finance customers are not even Muslims, drawn by transparency. Like I said, in the US, growing numbers of non-Muslims is baffling. I said backing principles rather than religious observance. So this is the conversation I want us to think about. It's an ethical, transparent finance option for any Ghanaian, not a religious product. So let's bring it all together. To sum it up, Islamic finance is not defined by the absence of interest rate alone, even though the name in Ghana has been structured around non-interest banking. I get it. But it is defined by a positive set of principles, shared risk, ownership responsibility, real economic activity, transparency, ethical screening is what shapes Islamic finance. Together, these shape a different relationship between money and the economy and connect Ghana to global capital pool worth nearly 6 trillion and growing. For Ghana, understanding these principles is the foundation for everything the rest of this series will explore. How Islamic banks actually make money, what riba really means, how instruments like murabaha, ijara, musharaka, mudaraba, and sukuk could serve Kenyan household farmers and entrepreneurs and the national economy. So I will encourage you to join us in our subsequent series. We're going to have part 2 very shortly, all right, where we will try to answer, if Islamic banks don't charge interest, how do they make money? Stay tuned, join us, keep dreaming, keep believing. Thank you for your time. I will see you soon. Assalamu alaikum wa rahmatullahi wa barakatuh.